And now, in studio, bringing his Midwest values from the Show Me State to the land of San Diego. He's a triple threat, licensed as an attorney, mortgage broker, and a top producing realtor who's crushing the competition. Here to deliver you what's happening in the trenches of the market. Your host, Michael Gaddis.
Welcome back to the Michael Gaddis Show on AM 1170 The Answer. I am your host, Michael Gaddis of FrontierLoanGroup.com. And as a lot of you know, I travel throughout Southern California giving workshops on reverse mortgages. And my travels take me when I say all over Southern California, I mean all over Southern California. I go to the San Fernando Valley, I've been to Ventura, I've been to Pasadena, I've been to Carson, I've been to Anaheim, Palm Springs, all over Southern California. And what I like to do is provide education to my clients. My workshops are not salesy. My goal is not to come and get you to try to sign up for a reverse mortgage. My goal is to educate you so that you can make a determination as to whether or not a reverse mortgage is right for you in your particular set of circumstances. So it is not geared towards trying to get you to sign on the dotted line. It's exact opposite. And when people go there after the workshop is over, that's usually the most frequent comment that I get. I thought this was going to be salesy, but this was so much more than what I thought. So I want to talk a little bit today about one of the topics that I talk about at my reverse mortgage workshops, which is HECM products, home equity conversion mortgage products, or reverse mortgage products. Because remember, home equity conversion mortgage and reverse mortgage are basically the same thing. So I'm going to talk about the different products available in a reverse mortgage. Now, most people think that they're like, well, what do you mean there's multiple products? I thought it was just a reverse mortgage. Well, it is a reverse mortgage, but as I said, education is important. You have to know the mechanisms. And what you can get in a reverse mortgage is one of three basic products. You can either get a fixed interest rate loan, you can get a monthly adjustable interest rate loan, or you can get a yearly adjustable interest rate loan. Now, being from Missouri, I know where we're very fiscally conservative. A lot of us immediately jump to the fixed interest rate loan and assume that, oh, that's what I want, fixed. I don't like any type of potential adjustment. That scares me. But I will tell you that the fixed interest rate loan is not the superior product of the reverse mortgage products, in my opinion. That's my opinion. Now, I'm going to tell you a little bit about why. Now, the pros of a fixed interest rate product is you get a fixed interest rate for the life of the loan. Goes without saying. Whatever interest rate you get stays the same. But when you weigh it out, and as I said, like anything you do in life, it's like putting some scales in front of you, and you weigh it. You have to put the pros on one side and the considerations on the other. So here are some of the considerations. You might not be able to take full advantage of your reverse mortgage benefits. That's number one, and I'll explain that a little bit more in a second. The only options are to pay off your mortgage and receive a lump sum payment. As a lot of you know, reverse mortgages have a lot of different product offerings underneath these three. For example, we have a powerful line of credit growth, which to me is one of the most amazing features of the reverse mortgage, the line of credit and its growth potential. The fixed product does not allow for the line of credit. You can only get that in the adjustable rate products. Remember, there's another product called a tenure payment, T-E-N-U-R-E. I know I'm from Missouri. I said sometimes it sounds like 10-year, but it's tenure payment. And you cannot get a 10-year payment, which is a fixed amount of money that you receive basically for the rest of your life. You cannot get that in a fixed product. So there's also no term payment as an option either. Basically, a term is a fixed amount of money for a period of time, which I don't recommend that option anyway, but you cannot get it in a fixed product. And one of the big things is you cannot receive credit towards closing costs. And one of the things I like to do with a lot of my clients is I try to find ways to minimize or eliminate their closing costs altogether. And the way that I do that is by giving a credit back to them in order to help pay for that. But I am not allowed to do that on the fixed interest rate products. So if you want a fixed interest rate product, you have to be prepared to pay for your own closing costs to get it. So that's one of the, to me, that's a huge consideration. And now going back to what I meant about not being able to take full advantage of reverse mortgage benefits, because with a fixed interest rate reverse mortgage, your only option is to receive a lump sum payment. So basically, they'll pay off your existing mortgage. If you have money left, you could take a lump sum cash payment. But there is a rule in reverse mortgages, which I call the kid in the candy store rule. And basically, the rule is that you cannot take more than 60% of your eligible principal balance during the first year. You can't utilize more than that. Or if you exceed the 60%, you can't exceed 10% above that. So basically what that means is that you would be limited on how much cash you could take out, and you would be leaving money on the table. You would not be able to utilize all the equity that you could have taken advantage of had you used the adjustable interest rate options. So for me, the fixed interest rate is not the best option. Then I like to go to the next option, and before I go to that, I have to explain a little bit about how adjustable interest rates work. Adjustable interest rates work based on two factors. You have a margin and an index. A margin is a fixed number that is in your loan docs. It's fixed, it remains the same, it never changes. And basically, you add that margin that's in your loan docs to an index. There are two indexes that are used in reverse mortgages. One is the monthly LIBOR index, and the other one is the yearly LIBOR index. These indexes change. So when on the date of your adjustment, they add your margin to what the index is that day, and that is what creates your interest rate, just in case you guys didn't know. So there are two products here. There's basically the monthly adjustable and the yearly adjustable. Now, the monthly adjustable is attractive. One of the pros of it is because it has lower initial interest rates than the fixed or the yearly adjustable. So, because the monthly LIBOR index is much lower than the yearly LIBOR index, also in the adjustable monthly adjustable, you can receive credits towards closing costs. You're able to take full advantage of your reverse mortgage benefits. Even the kid in the candy store rule, you're able to get all of them. You can get a line of credit with growth possibility. You can get a 10-year payment, and you can get a term payment. So you have the whole arsenal available to you with the adjustable products. Now, the consideration of the monthly adjustable is, number one, it is a adjustable interest rate, so it will change. Now, the reason I really don't like the monthly adjustable is because it's extremely volatile. And what I mean by that is it has 10% swings. It can swing 10% on any adjustment period, which is monthly, and it has a 10% lifetime cap. So this one is extremely volatile versus the yearly, which we're going to talk about in a second. Now, what makes it attractive to people is because the initial interest rate is so much lower. So if you are an interest rate driven person, you will be immediately attracted to this. But if you come to one of my workshops or listen to me right now, I will tell you to beware of that, okay? Caveat emptor, let the buyer beware that you could be subjecting yourself to some wild swings if the market in the indexes starts going crazy. Now, is that going to happen? I don't know. I can't say for sure. They've been pretty stable for a long period of time, but that doesn't mean they're going to remain stable. So my job is only to educate you so that you make a decision, and when you make that decision, if you take the monthly, and then all of a sudden the markets go crazy, and when you start adjusting upward, you're going to remember me telling you, and you can never say that I didn't tell you. So I did tell you. So the other option is the yearly option. Now, what I like about it is it has all the same advantages of the monthly, but it has protections in place. It has a 2% adjustment cap and a 5% lifetime cap. So the 2% adjustment cap and a 5% lifetime cap. Now, the consideration is it's a higher initial interest rate than the monthly adjustable, but that could change very rapidly. It could change in a matter of 1 month. You could be paying a lot more than the yearly adjustable because of the cap limitations and differences between the two of them. So, in my opinion, of the three products, the yearly adjustable is the best product because it gives you all the full range of reverse mortgage products, and it gives you protections to help limit what your adjustable interest rate can do. So in my in my opinion, the yearly adjustable is the superior product. Well, after the break, we're going to continue our discussion about reverse mortgages. You're listening to the Michael Gaddis Show on AM 1170, The Answer.